Dan Hillery is a finance professional and head of treasury at Buck.io, known for his commentary on investment strategies and involvement in the Bitcoin/MicroStrategy community online.
And, you know, then the question becomes, how much leverage do you take on as a company like Strategy? We can get into that later. But I think out 10 years, I think in 10 years, fiat will still exist. I think Bitcoin will be materially higher. And I think the value of $1 today in 10 years will be about 40% of what it is today. So if you believe all those things to be true, then the business of borrowing from the future in terms of future cash flows to buy Bitcoin today, doing so in a responsible fashion is a fantastic.
Dan Hillery. And then the question becomes, how much leverage do you take on as a company like Strategy? We can get into that later. But I think over 10 years, fiat will still exist. I believe Bitcoin will be materially higher, and the current value of $1 today in 10 years will be about 40% of what it is now. So if you believe all those things to be true, then the business of borrowing from the future, using future cash flows to buy Bitcoin today in a responsible fashion is a fantastic opportunity. Responsibly using future cash flows to buy Bitcoin today can be a highly effective long-term strategy, given his belief that Bitcoin's value will rise and fiat currency will lose purchasing power over the next decade.
Yeah, absolutely. I mean, you significantly de-risk a balance sheet when you don't have a period of time during which the debt has to be paid back, right? So like, obviously with all the convertible notes, there are periods of time during which they come due, right? There is a term to these convertible notes. Therefore, if Bitcoin, if they're not in the money, if they can't convert into equity, if they're out of the money, Strategy will have to either cough up the money to pay back the convertible notes to convertible note holders. That's a traditional just debt obligation, or they'll have to, refinance the debt and take a longer term time horizon, rolling that debt forward. So there's risk there, and ultimately what happens in bankruptcy for most traditional corporations is that the debt burden becomes too heavy, and ultimately the actual equity loses all its value, whereas the debtors now have a claim on the underlying assets that is superior to those who are holding the common equity. Okay, so they're de-risking this threat, and the threat kind of is a result of Bitcoin's volatility. If Bitcoin was not volatile, if it just went up 10% every year or 20% every year, then the debt wouldn't really be a problem, because you would know when it would convert into equity because it's convertible debt. We don't know exactly Bitcoin's price trajectory over the next 5 years, down to the T. So you need to be able to weather drawdowns and weather bear markets over any extended period of time. Therefore, having no actual term to your debt obligations de-risks the chance that Bitcoin trades down and you have to pay back these leverage or these debt obligations at a loss. That's what the preferred equities do. The only bet you're making with the preferred equity is that the long-term growth rate of Bitcoin outpaces the cost of capital which you pay on the preferred equities Yeah, I mean, ultimately it's a function of demand in the market and Bitcoin price, right? Like, so at the current moment, I think we'll talk a little bit about why STRC really unlocks a new market. Prior to STRC, which is their stable preferred equity, it's effectively a debt instrument, even though it's an equity instrument. It's a fixed income instrument, right? They had their common equity, which if there was enough demand in their common equity, which is reflected by the common equity trading at a premium to their Bitcoin holdings, they were able to sell it into the market and capture the difference between the inflated equity price and the price of Bitcoin. They're selling equity at 1.5x MNAV and buying Bitcoin at 1x MNAV. That's an instant value capture. So they were limited by the demand for their equity, right? They could only buy as much Bitcoin as people were willing to buy the stock at a premium to the Bitcoin. Okay, so that's a demand question. And in bear markets, there is a lack of demand of Bitcoin. And in that scenario, in that case, it's very difficult for them to purchase Bitcoin. What do they do with STRC? They created a new product, which kind of changes the demand function. Where prior the demand was leverage Bitcoin, that's MSTR. Like, is there demand for leverage Bitcoin? That tends to happen in bull markets in frothy periods of time. STRC, they're bringing a product to market that is there demand for high yield with low volatility paid out on a monthly basis, over collateralized by an asset like Bitcoin? We're seeing on a daily basis now with STRC trading over $100, $200 million of daily volume, that there in fact is demand in the market for this type of product. And they're changing the demand profile, right? Whereas before the profile was leverage and Bitcoin exposure, now the demand's yield. And how big is the total addressable market for a high yield product that has a very low volatility? Ultimately, that question is like as old as time. Everyone's looking for high yield and low volatility. That is a Sharpe ratio. That is essentially the benchmark of performance for all funds, private equity, private credit, even traditional asset managers. Strategy is trying to attack that market with STRC and create what is essentially an unlimited demand on the underlying Bitcoin, because every dollar of STRC purchased is a dollar of Bitcoin purchased. I think they're doing an amazing job. And no, I don't think there really is a cap on that demand, so long as the STRC dividend remains as high as it is, and so long as other assets aren't outperforming it. And what we're seeing is that, with interest rates as high as they are, high yield bonds are performing on par with STRC. Some other forms of, foreign bonds are performing on par with STRC. But if interest rates decrease, the demand for STRC will only go up. And, I expect the interest rate environment to be that of falling interest rates over the next few years, just because of the fiscal dominance regime we're in. The U.S. needs to monetize their debt. They need to debase the currency to pay off interest and entitlement spending. So I think STRC is perfectly positioned to provide a high yield, low volatility product in an environment where high yield is going to become more and more scarce. Yeah, I see what you're saying. And it sounds complicated, but like, let me just lay out the scenario for you, right? Let's say Strategy has $100 of Bitcoin on their balance sheet, right? And they have 30% of that outstanding. So they have $100 of Bitcoin on their balance sheet total. They then have $30 of preferred equities outstanding. So it's like part of the assets. You can consider it kind of like a liability, right? Let's just call the preferred equity a liability. So they have $100 of Bitcoin and $30 of liabilities in the form of preferred equities. They don't want to take that liability stack up to more than 30% of their total assets, right? So if they have $100 of Bitcoin, they have $30 of Stretch. They can't just sell another $70 of Stretch. If they do that, the liabilities, which aren't liabilities, but the liabilities will equal 100% of the assets. That would be bad. So what they have to do, if they have $30 of Stretch and then $100 of Bitcoin, if they issue another $10 of Stretch, what they've been doing is they'll issue $20 of MSTR. The $20 of MSTR builds their balance sheet. So that they go from $100 of Bitcoin total to $10 new of stretch Bitcoin plus another $20 of MSTR Bitcoin. So they have $130 of Bitcoin afterwards and $40 of stretch. So then the amplification ratio is maintained, right? Does that make sense?
It makes sense. Why 30%? Is that like some regulation rule or?
No regulation. That's generally what they've been adhering to. And their forward guidance in many of their earnings calls has been kind of a 30% leverage ratio or amplification ratio is what they're targeting. I mean, I don't know where their terminal multiple to book value or MNAV is. I don't know what their Bitcoin yield will be. I just know that it seems like they're going to maintain this 30% amplification ratio. And that if Bitcoin has a sustained CAGR of 30%, they'll likely have a sustained CAGR of about 36, 37% as a result of the yield and them sustaining the yield. And that ultimately results in almost 2 times outperformance over I think AI is massively deflationary to the entire economy. Technology is, automation has been. I think AI will continue to be. For the debt-based monetary system to survive, the monetary supply needs to expand via fractional reserve banking, lending, credit. And that ultimately will lead to further debasement, even in a deflationary society. So, I believe the only way to protect your purchasing power is to hold hard assets, and ultimately a digital monopoly on hard assets. Bitcoin is a much better way to do it, I think, than most forms of real estate, which would be my next sort of bet there. Obviously, gold has the self-sovereignty aspect and it's been performing quite well. I don't believe gold actually to be superior necessarily to something like real estate over a long period of time. But I think the hard asset trade will continue for a long, long time into the future. And I think Bitcoin will ultimately be the largest beneficiary of such a system. And people are going to be looking for growth. And it's difficult to find growth in a world where software is getting destroyed, because the biggest driver of growth across the entire equities market over the past 10 years has been software, obviously with NVIDIA, taking a large part of that performance. And when that, or if that ceases to continue, especially with like layer 2 AI, like in private markets, most of the growth has been driven by companies like Lovable and Cursor and different application layers on top of AI. They have a very small there's very little moat for a business like that, especially with the introduction of things like Codex and Claude Code. So I expect growth to be looked for elsewhere, and I think we're seeing this in silver. We're seeing this in metal speculation, and ultimately, I think longer term we'll see it in a growth as a digital monopoly that's looked at as a growth hard asset, which is Bitcoin.
What if the secret to long-term corporate growth wasn't just revenue or assets, but strategically managing Bitcoin on the balance sheet? Maintaining a disciplined leverage strategy is essential when managing Bitcoin on a corporate balance sheet. Using preferred equity like STRC allows companies to issue instruments without creating traditional debt pressure, effectively de-risking exposure to Bitcoin's volatility. For example, a company holding $100 of Bitcoin with $30 in preferred equity can issue additional STRC while simultaneously expanding common equity to maintain a target 30% amplification ratio. This approach ensures liabilities never exceed a safe portion of assets, protecting the balance sheet during drawdowns over a multi-year horizon. Sustaining this ratio can result in nearly double performance of Bitcoin itself, combining yield with long-term appreciation. Beyond corporate mechanics, macroeconomic trends also play a role. Technological advances in AI and automation are exerting deflationary pressures on traditional economies, creating an environment where fiat currency may continue to weaken. Hard assets like Bitcoin become critical for preserving purchasing power, offering both scarcity and growth potential unmatched by most real estate or even gold. By treating Bitcoin as a core growth asset and managing leverage prudently through instruments like STRC, companies can capture upside while insulating themselves from volatility, positioning digital assets as a primary driver of long-term portfolio performance. Strategically managing Bitcoin on a corporate balance sheet requires a careful balance of risk and opportunity. Instruments like STRC allow companies to scale Bitcoin holdings while de-risking exposure to volatility, providing predictable yield without the constraints of traditional debt. Maintaining a disciplined amplification ratio ensures liabilities remain proportional to assets, enabling firms to weather market drawdowns while capturing long-term appreciation. In an environment where fiat faces debasement and traditional growth sectors like software are increasingly challenged, hard assets with digital scarcity, such as Bitcoin, become central to preserving purchasing power and driving portfolio growth. Companies that integrate Bitcoin thoughtfully, leveraging preferred equity and maintaining measured risk parameters, position themselves to outperform both traditional assets and Bitcoin itself over extended periods, establishing a new blueprint for corporate strategy in a crypto-driven financial landscape. Bitcoin is reshaping corporate finance, and the strategies unlocking its full potential are just getting started. If this gave you insights, don't forget to comment, share, and subscribe for more crypto and finance updates. Could Bitcoin become the core growth asset for corporations in the next decade, reshaping how balance sheets and investments are managed?